From downtown Milwaukee, welcome to Money Talk with Bob Landis. Each week, professional advisors from Landis & Company Investments discuss the latest financial developments, offering timely insight and long-term perspective.
This is Money Talk for the day after Christmas and the last one of 2025. The Packers host the Baltimore Ravens in Green Bay Saturday night, and looking ahead to New Year's Eve, the Bucs are playing the Washington Wizards at Fiserv. For you runners, there's a New Year's Day 5K, 10K run at Estabrook Park starting at 7 a.m. New Year's Day. Yeah, I'm not going to do that. We have a theme today for the last podcast of 2025. It's animals. From Kirkland, Washington, a thief disguised as a 6-foot-tall pink bunny attempted to steal thousands of dollars of luxury handbags. He was arrested before he could hop away. Let's wrap up 2025 with just a few more animal stories. A Swedish musician has taught an octopus how to play the piano, but only one piano at a time. You'd think with 8 arms they'd do more than that. But I still buy tickets to watch that. In Somerset, England, the English Village Council has decided to euthanize domesticated reindeer that live on a farm. Their reasoning is they are endangered, which I know makes no sense. Their decision is under appeal. I would hope so, because to top it off, the reindeer are named after Santa's 8 tiny reindeer. And we end on a high note. The city of Madison has outlawed the declawing of cats. So don't be surprised if on New Year's Eve, when you see a bunch of cats knocking back a few to celebrate. On the podcast today, we have Dave Sandstrom, Adam Baley, Joel Driesing, and with a special edition of Money Talk, here's Kyle Tetting.
Well, thanks, Max. We do have a theme for this podcast this year, and as much as I like the animals, I think we're going to talk a little bit more about kind of the look ahead for the year of 2026. We record this podcast a bit early, so no closing numbers, but worth at least a conversation on kind of expectations for the year ahead after, at least as we're recording this, what has been an incredible year so far for 2025. And I think I'd be remiss, Adam, if I didn't start with a conversation on earnings. So 2025, another strong year for earnings for the S&P 500. It looks like, at least where we are today, once we start getting fourth quarter earnings in the new year, but targeting around a 13% growth rate for the earnings on the S&P. And as we look into 2026, an even stronger forecast, I think important for investors to understand why the earnings number is as important as it is, so that as we look at a potentially another double-digit growth rate next year, you can put some context around just what that might mean for investors.
Yeah, it all comes down to interest rates and earnings, and that's what should be driving stocks long-term. Certainly what we've seen throughout 2025, and that's the hope and the plan for 26. And you look ahead for corporate earnings in 2026, could be somewhere around 15%. Candidly, usually as we start the year, those earnings projections tend to be a little bit rosy, so just take them with a grain of salt. But even still, something around 15% is impressive, given some of the turbulence that we've seen in the economy and in businesses this past year. And then you pair that with interest rates, right? That's the other half. You have interest rates and earnings. And for interest rate, at least as we're finishing up the year, the 10-year Treasury is somewhere around 4.2%, give or take. And that represents still historically low borrowing costs for people and for businesses, and that's good. The one thing I'll just kind of mention on interest rates and earnings, the intersection of those two things is valuations. And candidly, as we start 2026, the U.S. stock market is relatively expensive. The forward PE is somewhere 22, 23-ish times future earnings, and that is some lofty valuations, just to give some context there.
Yeah, at that 22, 23 times earnings, we get a forward earnings yield. So just simply taking that forward price to earnings ratio, flipping it on its head, taking the reciprocal, you get, instead of what do I get in the S&P, what do I get in terms of yield for a dollar invested? And right now at about 4.37 cents for every dollar put in the S&P, you get a pretty good understanding of what kinds of deals are out there. When you talk earlier about kind of where the 10-year Treasury sits, well, again, easy math here. The 4.3, 4.4 is a bigger number than 4.2 you get on the Treasury. It tells me that there is still some optimism for stocks, even though we've said for years that those prices are expensive. I think worth pointing out, we're not that far off the earnings forecast and what was an admittedly rosy earnings forecast to start 2025. And so if we again have an admittedly rosy outlook for 2026, well, maybe we don't quite meet those expectations, but it does, I think, give some room for stocks to continue to grow in 2026, even starting from a fairly expensive place. And I think the key there is that there are risks to that forecast, right? There are risks that perhaps we don't meet those earnings expectations. But again, Dave, as Adam mentioned, the valuation piece, I think, is part of that conversation as well.
I think it's important to point out, Kyle, you need to look at the transition of the composition of the S&P over the last 10 years and how it has really shifted to more of a tech focus, growth stocks being a much bigger piece of the pie. Looking at the top 10 companies right now in the S&P from a market cap position, it's all tech. Right across the board. And the value of those companies now approaching $20 trillion. Just as recently as 10 years ago, the top 10 companies had a market cap of about $3 trillion. So you could see the money flowing into tech. We've been accustomed to paying up for tech companies. Profits have justified paying a higher price for that growth. And so I think naturally with the concentration of the companies trending towards growth, you're going to see a little higher PE going forward, and the profits continue to be represented by that.
To mention those like Magnificent 7 or those Mag 10, I just kind of wonder, are they going to continue to be magnificent in 2026? Certainly, you look back over the last 4 or 5 years, they have just dominated the markets, dominated earnings and cash flows, and they've risen somewhat to justifiable levels just given the amount of profits that are there. But now they command such an enormous weight of the S&P 500 and at lofty valuations, the math gets very difficult for them to continue to carry us forward. At some point, we got to look at the bottom 490 and say, okay, you got to have your comeuppance too. We're going to need to see more broad-based advancement for the rest of those 490.
And what's interesting to me, if we look at some of the investment themes from this year, they were so heavily reliant upon data center spending, so heavily reliant upon artificial intelligence. And we saw these massive runs in some of those Mag 7, Mag 10, however you want to define them names. But we didn't see a lot of capital expenditure in other areas. We didn't see businesses really spending the way that maybe Microsoft was to build out their data centers or Oracle was to build out their data centers. And what's interesting is that there is a lot more potential manufacturing build out on the horizon. And when you look at who would benefit from that, perhaps some of the industrials, Dave, we look at the need for things like tractors just to clear land. But if we're looking into what's kind of the next phase of that spend, perhaps it evolves beyond just those artificial intelligence names and into some of the other businesses that maybe they touch.
Well, and certainly, Kyle, from the perspective of what type of employees are benefiting, not necessarily, the top-end tech innovators. It's going to be a lot of nuts and bolts types of construction employees, lots of contractors, electricians, plumbers, for this initial spend out or build out that you're referencing. These data centers are very labor intensive to construct from that perspective.
Joel, you and I were talking maybe a week or two ago about just the immense power consumption that is needed here in the state of Wisconsin alone. You've served on a board that directly has conversations with the state power companies, and certainly you understand that fairly well. What have you learned in those conversations?
I mean, these data centers are massive consumers of electricity, and we've seen most of the country has seen electricity rates go up. So there's going to be more of that ahead, and especially there's going to be controversy over how much these companies will partake in paying the higher bills, but they could consume a lot of power.
Yeah, I don't know why I got to pay a higher utility bill just because Google's using more power. Like, send them the bill, not me.
Yeah, I think that's fair. And the unfortunate reality is that it takes some time for those ratepayers to step in. And meanwhile, we got to build out the capacity. And so I think if we look at again, kind of the investment thesis beyond maybe the pain as the ratepayers. Well, okay, those utility companies are rate setters, right? They get to go out and tell you, with approval from state governments and from governing bodies, here's what we think you should pay. And so there is almost some built-in profitability, and add in some increase in demand, and all of a sudden, potentially some of those utility companies look a little more attractive because for years they've been steady, if not attractive, dividend payers. Those dividends look even more attractive, and now maybe their profits are able to take a little bit of a step beyond what we thought.
And I think as citizens, too, we have to sort of balance the long term versus the near term, and saying, yeah, we're going to pay higher rates now. What's in it for me in the future? And sometimes if you look into the future, it's not as generous, but those are those sorts of decisions that customers have to be thinking about and talking with their local governments who are considering these data centers, and also communicating with the officials who regulate the utilities.
Yeah, more than fair. And Adam, you mentioned earlier in the show, it's all about earnings and interest rates. I think we touched on the earnings piece, but worth pointing out that this kind of massive infrastructure build out we are seeing in the form of data centers, in the form of manufacturing capacity, may benefit from the other part of that conversation, the interest rate piece, in that the expectation for the Fed potentially in 2026 to continue to reduce the overnight lending rate would certainly make it a little more palatable to borrow money to spend on this build out. But I think there's broader implications for falling rates as well.
Yeah, for one, there is a lot of debt outstanding in the data center space, for what it's worth. But as interest rates are likely expected to fall into 2026, the Federal Reserve widely expected to lower rates maybe a couple times, if not a little bit more. I don't know how far they can go, even by their own estimation. They believe that the floor on the federal funds rate is going to be somewhere around 3%. So we can fall, but it's not like we're going to hit zero unless like we go into a recession or something like that. But as interest rates go down, at least in the overnight lending, because that's what the Federal Reserve can control, is literally what banks lend to one another overnight so that they can open up for business. The hope is that the 10-year Treasury will float down with that. Haven't seen too much of that so far in 2025, but as the Federal Reserve lowers rates, hoping to see borrowing cost ease. That would be for corporations and for people, homeowners alike.
Yeah, the one thing we did see in 2025, and you had written an article kind of touching on this earlier in the year, was some normalization of the yield curve. We had spent a good bit of time with long-dated rates, those rates on longer maturity bonds significantly lower than what we saw in the overnight lending rate. Well, the Fed's decision to move rates lower on the short end helped to alleviate some of the concerns of that. It's yet to be seen what will come of that resolution, because part of, I think, what you were writing about is the resolution of that inversion isn't always a positive outcome.
Yeah, and it wasn't just like an inverted yield curve, which usually is a sign of financial stress, but we had a very unusual time, which we're still in at the moment, where we have a U-shaped yield curve, where we have high short-term rates, lower intermediate, and then it's back up when you look at 10, 20, 30 years. We're still in that environment at the moment, and it is a sign of just high stress and high uncertainty in the credit markets. And usually how that's resolved is short-term rates come down. And usually they come down, at least if history is any guide, if there's historical precedents, it's because there's economic hiccups along the way that require shorter-term interest rates to deal with.
And I think it's important, Adam, to point out that, we're coming off of just unprecedented monetary policy for a long period of time following the financial crisis, with the Federal Reserve taking interest rates to zero for so long. I mean, look what happened to the mortgage industry with people getting, mortgages for 30-year fixed for 2%. I mean, I literally had 2 conversations with clients this week that, in the past, you would pretty much with 100% certainty tell someone, yeah, you probably need to get rid of your mortgage before you retire. And now, I heard from people that had 2.1 and 2.4% mortgages. That's a little tougher conversation to have. Do you really want to liquidate a large piece of your portfolio to pay that off? I mean, that's...
you let that one go to the last minute on the last day of the 30th year.
So the distortions were everywhere during that time. So we've kind of normalized now. And I think, to your point, with the Fed maybe kind of settling in on that 3% target, I think you're going to see some stability to the interest rate market.
I have joked with clients in that scenario that they should call the bank and see if they're willing to give them more money. And the answer is obviously no. But to your point, we're in that universe in which there is still a lot of outstanding debt at these very low rates. And so watching what the Fed does into 2026 will be such an important part of how does the economy shift, because we are counting on potentially some lower mortgage rates to help free up the housing market. We are counting on, again, those same interest rates more broadly to kind of free up some of the economic activity. But the other thing that might help consumers next year is that we did get some clarity on taxes. And Dave, you talked in our seminar in 2025 about some of the changes coming from the maybe misappropriately named One Big Beautiful Bill Act. It certainly was big. I think elements of it may have been beautiful depending on how you feel about tax law. But it also was a bit of a mess to try to wade through. And one of the things we're learning is that we may not have even seen many of the impacts that are coming from things like deductions on tips, deductions on overtime, until we actually get to filing season next year.
And it could really bring up an opportunity where we see a little bit of extra money coming into the average consumer's pocket come tax return time. Right now I'm seeing some projections that we will see an elevated amount of return on average coming, and that typically has kind of boosted consumer spending a bit. But you're right, Kyle, there's still some confusion out there, but there is, the big piece of that is that tax rates were made permanent under the current tables, and that does provide relief across the board for taxpayers. And generally when people are getting more of their paycheck, they're going to continue to spend more of it. So.
And not just individuals, but corporations, right? That we have permanently extended corporate tax rates. We have made permanent some provisions in the corporate side of the tax code that make it a little more favorable to invest here domestically in research and development. So I think if we are looking at how businesses now transition some of their thinking into 2026, well, it's clear the focus has been on bringing things back to our country. And I think next year, 2026, could be the year in which we really start to see some of the impact of that. Again, a long way to go. We have tariffs still kind of hanging over our heads right now. We've got a number of other conversations. But I do think those are some of the pieces that give me a little more optimism about the economy more broadly. And then, Adam, maybe the last piece is we this year hit the largest portion of the population hitting age 65. You and I both know well that age 65 is the time in which most people start to look at retirement. 4.5 million people turning 65 this year. Well, the nice thing about having an older population overall is that you've got a lot more certainty about what spending looks like. And if consumer spending is such a big piece of our economy overall, well, having a more mature population is certainly going to put a bit more of a floor on what might happen to spending if the economy slows a little.
Yeah, for a lot of those folks who are 65 and beyond, consistency for most of it, because you know what your bills are going to be, you know what your travel is going to be, you know what your Social Security income, if you got access to a pension, you know what that's going to be, IRA distributions, required minimum distributions, all that sort of stuff. So that there is some consistency in that regular spending where it's just not as fluctuating as in the years when so many of our population was in their working years, and layoffs could really impact that. So that it does underpin some consistency for consumer spending going forward, and hopefully that's going to materialize in 2026.
We've spent a good bit of this show talking about, I think, what's happening here in the U.S. I think we'd be remiss if we didn't discuss at least a little bit of the outlook for the rest of the world. As murky as ever, certainly some of the geopolitical risks and some of the wars that are still raging on are going to weigh on some of this forecast. But one of the things we saw in 2025 was a dollar that weakened fairly significantly, that boosted foreign returns. And I think if we look at our portfolios and how they might evolve, perhaps one of the ways we see some diversification, some shift away from just the risk of expensive stocks here in the U.S. is to continue to push a little more overseas, Adam, potentially with the hope that maybe currency can continue to play a role in pushing those non-U.S. stocks a little higher.
Yeah, 2025 was, I think, the year for like the active fund manager for one, but it was also the year for like the global investor and for the non-U.S. investor, because there's a lot of returns that have come outside of the United States, and the falling dollar has been a big part of it. And one of the reasons why is the dollar has weakened from where it was, and it's down considerably from where it was when we started the year. That would work against you if you were a U.S. traveler going to like Germany or Paris, because now stuff is more expensive for you. But you, the U.S. investor in those overseas businesses, well, now all of those revenues in foreign currencies are worth a whole lot more in dollars, and it's led to some outsized gains in your non-U.S. stock funds, and that's a trend that's likely to continue into 2026. And you look overseas and in Europe, and a lot of the issues that we have are not the issues that they have. For example, Europe gets to trade tariff-free with all of Europe and Asia and Canada and Mexico. Asia gets to trade largely tariff-free with Asia and Europe and Canada and Mexico. So our issues are not their issues, and there's a lot of well-run, very profitable businesses trading at reasonable prices, much more reasonable than some of the lofty valuations we have here in the United States. You put those things together, and there could be some more room to run overseas.
And I'd also add, Adam, that there's a lack of the tech giants in those markets too. So if you are concerned about diversifying the portfolio a little bit away from some of the large, massive tech exposure here in the U.S., there are some compelling ideas in some of those international markets that kind of separate you from some of that.
Yeah, I think it is such an important point that regionally we sometimes have these focuses, right? That if you are in a largely German background steel industry or city, there might be a pretty good brewing industry around you. And on the other hand, you want exposure to maybe power generation in Europe, you're probably not going to buy Wisconsin Electric. And so I think there are some reasons why we can move into some areas that offer better diversification than just buying, again, those 30 or 40 tech names that have been such a big piece of the story for so long. I think we would be remiss if we didn't at least talk a little bit about forecasts for 2026. It's almost a fool's errand to try to put a number on markets, on rates, but I think broader trends certainly are something worth discussing. And Joel, one of the ones that we've seen building for much of this year, which I think is likely to persist into 2026, is this continued rise of fraud, of theft, not the least of which driven by just how easy it has become to try to separate people from their money.
Yeah, I think especially with the growth of artificial intelligence, a lot of the scammers out there are tricking people a lot more easily, and it's harder to tell what's legitimate and what's not. And so it's very important for people to first be careful, but also if they have any doubts to check with people who can help them think through things. And I know a couple of weeks ago on the podcast, Dave was saying, or maybe it was in one of our meetings. Anyway, I've heard Dave talk about how that he'd rather have a client call him and say, "Hey, Dave, what is this here? Is this legitimate?" than to have them make the mistake and press the wrong button or sign something that they didn't mean to sign.
And they're getting better at it, Joel. Let's face it. I mean, it used to be that scams were intentionally dumbed down to be almost ridiculous to the average person because they were really trying to sniff out somebody that wasn't sharp enough to determine that was a fraud attempt, and then they could get them over the finish line. But that's not the case anymore with artificial intelligence and other availability of information on people. These are much more sophisticated attempts at getting to your money. So I think you just have to, unfortunately, you have to be very cautious. You have to be, really question everything that you're getting as attempts on your phone or your computer or even if you still have a landline at home, they'll call you there.
And even in the mail. And we're spending more of our resources, more of the time that we spend in meetings talking with one another, more of the things we're putting on our website and our newsletters to remind people to be careful.
Yeah, one of the things I just remind people, always be vigilant. It reminds me like the Boy Scout motto, always be prepared, but always be vigilant with stuff like this. Some of the scams are pretty sophisticated. And if you feel like something's suspect or not Right. Share it with others. Bounce it off somebody else. Like, hey, is this normal? Like, have those conversations with people if you feel unsure.
I think those are such important points, and Joel, you hit it. We are certainly going to be spending a lot more energy in the year ahead just in making sure that we are aware of what's out there, we're aware of how to help, that we are getting those messages out to clients and anybody else that will listen. To the extent you think you know someone who might benefit from hearing that message, point them to resources you trust, whether that's our website, our newsletter, whether that's other resources out there that you think speak on the matter well. There's no shortage of good publications that are discussing these issues. But I think that the best thing we can possibly do is continue to expose these messages to those that we think are going to be impacted by them. And candidly, I think the closer we get to some of what we are seeing from a technological perspective, all of us just continue to get drawn more and more into it. So I think as far as forecasts go, that's the easy one, right? Of here's what is going to continue to progress. I think if we think more broadly about markets and the economy, like Dave, Adam, maybe not to pin you down on numbers, but maybe Dave, I'll start with you. Broad thoughts on kind of where we're headed in the new year with everything we've talked about, with everything we've kind of looked at. What are you kind of seeing for the year ahead?
Well, Kyle, I have to continue to focus on the amount of spend that is still on the table from big tech. I mean, right now, we're going to top out the year at about $360 billion that's gone into the infrastructure. Next year, the forecast is for about $450 billion. It's hard to imagine an economy that stops if that actual spend is out there. So I would expect continued economic growth in this upcoming year, just based on what we're talking about piling into the economy from a spend standpoint.
I think that's fair. Adam, anything in particular that you're looking at in the year ahead?
I think just some modest economic growth. By the government's own estimation, GDP somewhere in the neighborhood of like the 1%-ish range. I think that's fair. For corporate earnings, I would love to see a 15% earnings growth number, but candidly, that's priced for perfection. I think we're just going to have to walk back some of those estimates, maybe to slightly more realistic numbers, but still some room for some modest economic growth.
Yeah, I think both of you are telling a similar story, and that is one that we've been telling for a while here. I think 2026, perhaps the year that we see some continued economic growth, albeit slower, albeit with some more modesty necessary. I would be ecstatic to see some of that spend, Dave, that you're talking about. And again, I think realistic to think that the outlook has been rosy. And if we do have to walk it back a little, well, I'd rather walk it back from a position of strength than walk it back from what has always been a place of weakness. And so I'm excited that we enter 2026 on a fairly strong foundation. Excited that we have some of these stories to continue to tell. As always, we enjoy doing the program for you. We wish you a happy and prosperous 2026, and we will talk to you again next week.
Thank you for listening to Money Talk with Bob Landis. If you have a financial question you want answered on next week's show, email it to moneytalk@landis.com. To keep informed throughout the week, visit our Money Talk page at landis.com.